Welcome back, ladies and gentlemen. Indeed, a great presentation by Centilon. Of that, we move on to the panel session. Very interesting and very powerful topic and subject: digitalization shaping the future of lending in NBFC. And to discuss on this wonderful panel, I have with me a plethora of experts of the same domain from the NBFC sector. So let me introduce, without further delay, our honorable panel members in sequence. Joining first, we have Unni Krishnan, the CDO from Sri Ram City Union Finance Limited.
Hi guys, it's nice to be
A
part of
warm
this.
welcome to you. A warm welcome to you, Mr. Krishnan.
Thank you.
Joining next, we have Anish Chaudhary, the SVP and Head of Products and Digital and Marketing from Edelweiss Financial Service. Welcome to the panel. Joining next, we have Amit Kothari, the CTO from Cubis Capital.
Hi guys, good to be here today.
Next, we have Mr. Rahul Mule, the CTO from Adani Capital.
Hi, good afternoon, everybody. Thank you, Sana.
A warm welcome to you, Mr. Mule. Joining
Thank
next,
you.
we have Kishan Kumar, the CTO from ASK Investment Managers Limited.
Good afternoon, ladies and gentlemen.
A warm welcome to you, Kishan. Joining next, we have Anand Narayan Swamy, the CCO and Digital Transformation Evangelist from Centilon.
Yes,
Warm
thanks, Anna.
welcome to you, Mr. Narayan Swamy.
Afternoon, everyone. Thanks, Anna.
Joining next, we have Rishikant Dubey, the Chief Risk Officer from Muthoot Microfinance Limited. A warm welcome to you.
Yeah, good afternoon, everyone. Thank you, Sana.
And now, ladies and gentlemen, let me introduce you to the moderator of this panel session, Ms. Jaya Janardhanan, the COO from Indostar Capital.
Thank you, Sana.
A warm welcome
thank
to you,
you.
Ms. Jaya. So, Ms. Jaya, all over to you, the captain of the ship, the moderator of this panel. I am looking forward to a fantastic session of all the experts here. And of course, the moderator, Ms. Jaya. I'm sure the panel is in wonderful and able hands. Hope we have a fantastic panel. So, all the very best panel members, wishing a great success in the panel. Thank you.
Thank you, Sana. Good evening to all of you. I think I could not have asked for a better panel to be moderated than what I can see here. The CTOs and the CDOs of the who's and who's of the industry is here. So I'm sure this discussion is going to be very, very focused, interactive, and I'm sure the audience will love it. So let me give you a background about why I was looking forward to this discussion. I have joined the NBFC from a banking career, and I've moved to the NBFC for the first time in my life. And I moved it during the period of pandemic. And from the day I joined, I have been hearing this concept of digital lending, the disruption, the changes that the digital platform, the lending platform, which is transforming itself into a digital platform, is causing a huge noise in the industry. And that became a very interesting subject. And as an organization, we have also embarked on the journey of digital transformation. And that's why this particular subject is very, very interesting, because I would love to hear from all of you. And I'm sure you are the guys who are driving the ship in the respective organization, about how this digital transformation in the lending space has caused disruption, has brought about customer experience, has brought about our ability to manage security, our ability to do decision making. And these are some of the things I think the audience will love to hear. So I think from the very go, I think Rahul, based on what we hear, what's all this about digital, this disruption in the lending market? What is it all about? I mean, I think that's something which everybody would love to hear. What is it? Why are we calling it as disruption?
Right. So I think thank you, Jaya, for the the brief that you gave about yourself. Thanks, Sana, for the introduction, and I look forward to this discussion. So coming to your question, Jaya, I think digital disruption is, I think, the most widely talked terminology in today's world. And when I hear this word disruption, the obvious thought which comes to our mind is, why is it a disruption? Is it that things were not going the way they were supposed to, and suddenly some entrants have come and they have displaced, the market competitors which were already running the show? Is that the case, or is it something more than this? Now, the way I look at disruption today is, in the light of the kind of customer segments that we are dealing with today. So let's take an example. The kind of borrowers that we have. If you look at the typical segmentation of the borrowers today, we have the borrowers falling in the age group of around 25 to 45 years of age, which clearly means currently we are lending to a generation which is either the millennials or they are from the generation X. Now, when we talk about disruption in this parlance, when we say disruption, we are talking about addressing the needs of two broad markets, I would say. One is obviously the population which resides in the cities, metro cities of India, tier 1 cities of India, and the other side of the population is the tier 2, the rural population of India. So these are the broad level categories that we look from a customer segment perspective. Now, if I were to talk about the tier 1 cities, the metro cities, the kind of population that is going to become our borrowers, they are basically the generation Z now. When I say generation Z, currently they are somewhere in the age group of around 9-10 years to around 25 years, and that is the age group that we are talking when we talk about Gen Z. Currently we are probably our borrowers are people from the millennial group. They are used to the digital solutions, opting for digital solutions. Gone are the days where people have to walk into branches and opt for a loan, fill some long forms, application forms, and wait for a loan to get dispersed. So I think those times we are almost done away with. The next generation, the generation Z that I am referring here, now this generation is going to become almost 50-60% of your contributor among your borrower category. So what is going to happen is in the next 5 to 10 years, people in the age group of 9 10 to 25, they will probably proceed and become your major chunk of your borrowers. So when we talk about this generation, who are going to be our future borrowers, what is it that completely that this particular generation Z is able to engage with? So we are talking about social media. We are talking about influencers coming up at large. Especially I've seen this in the fashion industry. What I feel is disruption is, of course, it is ongoing. It will further disrupt, but at the end of the day, next 5 to 10 years are going to completely change the game. What I mean by that is today probably we are, of course, from a technology perspective, we have already leveraged, most of the businesses have already leveraged the state of the art technology platforms that are available, technologies like AI, ML, the data warehousing, business intelligence, everything has been put to use in most of the cases. But I think right now there is still a segment, still a area which is about the social media influencers. This has been, I don't think it has been leveraged to the fullest potential, especially from an NBFC and a BFSI domain perspective. I feel that is an upcoming trend. We need to, have some engagements done with these influencers who are probably, around 25, 30 years of age. That segment is completely missing. Those engagements are currently missing. The other wider population that I was talking, which is the rural population. Now, when you look at the rural population, even they have access to smartphones. So eventually, they are the ones who are actually, going to be digital savvy equally. When you compare it with the metro cities, at the same time, they will have this concept of moving from what their fathers, forefathers, the way their fathers and forefathers borrowed. They will not really fall on those kind of methodologies anymore. They will also look at what is Who are those influencers in this industry? Because there is a strong followership which is getting developed, even across the BFS segment. So typically, it becomes very important that while we are talking about disruption, businesses are able to scale up and they are able to look at different strategies from a long-term perspective. So when I say strategies, what I mean specifically by strategies is, there has to be a collaborative model purely from a business model perspective, which have to get developed. Certain NBFCs, have already started looking in that direction. The age-old models which have been working in the past may become obsolete in the coming days. What is going to become important is how you are able to collaborate with different fintechs. That is one model that I clearly see, that is going to work in the long term. Second is, how are you leveraging on the peer-to-peer network, where the borrowers have options of multiple lenders, where if I am a consumer, I have the option to choose my lender, because it is the era of making these options available. I want the freedom to choose from whom I need to borrow. Gone are the days where I need to plead to get a loan, right? So those days are gone. Now I have a plethora of options available, and that is where the peer-to-peer model, I think, is going to work in the long run. The third interesting model, I think, is the aggregator model. Basically, we have lenders who are available on a platform. They are willing to lend to a specific segment. They have certain specific programs and products available for the market. And how are we able to leverage these models to build a successful customer segment? That is obviously the story of the future going ahead. And of course, when I talk about alternate models, so one is obviously the business model side of it. Other important aspects from a digital lending perspective is, how quickly are you able to come up with alternative scoring models in the industry? Today we have a lot of credit specific checks which are done, but I think these alternative models, where depending on the customer behavior, depending on the spending patterns, alternate scoring models have already started coming up, and lots of NBFCs, banks have started leveraging on those models. So I think this is going to be another game changer going ahead, and it is very important to strategize in a way that your business is able to leverage on these alternate scoring models in the long run. Of course, I think there is enough. We keep talking about blockchain technology, although I would say blockchain technology right now is at a very nascent stage. But I think in the next 3 to 5 years, blockchain technology is just going to take over everything. So what are the benefits that blockchain will bring to the table? The clear benefit that I see is, I think it is going to accelerate the loan approval process. It is going to help manage your loan payments faster. It will provide transaction data on a real-time basis. I think it will connect borrowers with lots of private lenders as well. So I think the future is going to be great. There has been a certain maturity which has already come from a digital transformation perspective. But yes, next 3 to 5 years, again, new models, new business models are going to come up. We'll have a lot of engagements happening between larger banks, smaller NBFCs, between NBFCs and fintechs, and that is the way ahead to work in a collaborative manner. I think that was my perspective about this topic.
Thank you so much, Rahul. I think very aptly put. Obviously, it's the product, it's the kind of customers that we're targeting. It's a kind of digital developments that, I mean, the changes that are coming about in the industry, and I think it's here to stay. So if you're not part of it, you're out of the race. So it's actually disrupting the entire way as we do business. So it's kind of rebuilding the blocks right from the start. Thanks, Rahul. Thanks so much for your inputs.
Thank you.
So when we talk about disrupting the lending space, it actually means that there are a lot of players in the market who are the traditional players, the banks, the NBFCs, which had a traditional model of lending. So I will, ask Mr. Unikrishnan to probably share the views. What do you think that the existing lenders, the traditional lenders, are they moving in the same pace which is required in the disruption, or you think that they're being out of the? I mean, they're kind of lagging behind. How do you see the traditional people competing in this space, Mr. Unnikrishnan?
Thanks, Jaya. I represent Shriram City, and I think the question is very relevant to the business that I operate. If you look at Shriram City, we are an NBFC which is predominantly present in tier 2, tier 3 cities for the last decade, I would say. Right from for the last 45 years, our presence is predominantly in the tier 2, tier 3, tier 4 cities. Now, what we realize is that we did an analysis to understand how we are positioning ourselves. Since we are targeting the smaller towns and the smaller cities, by virtue of volumes, we are India's largest two-wheeler financier. We are largest MSME financier in terms of volumes. So we realized, I think we were in a very good position, but we realized that if we sit back, probably we will not be relevant in the business. So we did an analysis and from our existing customer base. And what we realized is close to 75% of my customers are below the age group of 35. Okay. And almost 70% of my customers are currently having smartphones. Now, why I'm talking this with a lot of passion is because we're talking about people in small towns. Okay. These are my customers. So that's when we realized that if we conduct our businesses in the old fashion, probably we will not be relevant in this business anymore. Okay. The pandemic also taught us a big lesson. Okay. Till then, our collections were predominantly. I'm happy that we realized this somewhere towards the mid of 2019 that we need to move into the digital way of doing things, and so we completely brought in the online payment methods and things like that. And what we realized is when the pandemic hit us, what kept us floating was the online payment modes that we had activated almost 6 months before the pandemic. And I'm happy to say that the adoption by our rural customers to the online ways of making payments was superb. Even the data supports that. If you look at the overall payments that happens through the UPI, close to 50% of the transactions happen from your tier 2, tier 3, tier 4 cities. Okay. Likewise, so all these things made us realize that it is high time that we move on to the digital way of doing things. So today, what our focus is, yes, our strength has been the people connect, the connect that we have in the rurals, the connect in the rurals. But we also realize that customer is ready to transact without having another human being right next to them. The fact that they are accessing their cell phones and transacting, making a payment itself is an indicator that there has been a paradigm shift in the way the customer thinks, whether it be in an urban customer or a rural customer. So traditional lenders, it's not a matter of choice that they have, whether they want to be where they are or where they will want to be relevant in the coming years. So the question is, I think almost all the traditional lenders have started realizing that, and there is a lot of online products that is being launched at Shriram City. We have a mantra of releasing at least one online product every 2 months. We've embarked on that journey. We have started the rollouts now. So I think this is the same that we see across all the traditional lenders. And if you do not do that, we will not be in the game, as the customers that we are dealing with are no longer the ones who were scared to transact or to borrow or without a customer interaction. They have upgraded. Everybody is upgraded. Yeah, and the most important thing that as the digital team that we are here is, let's understand one reality that our customers are not very comfortable in English. So if I want to ensure that the digital reach is really good, if customers adopt to the online way of transacting, self-service, do it yourself journeys, the content, the applications has to be regional. If without that, uh, the reach will not be to the extent that we are expecting. So I'm sure that you will not find a traditional lender in the next 3 years from now. So probably all of us would be competing with the Amazons of the world.
I think that's quite well said, Mr. Unikrishnan, because For me, when I was embarking on this project of digitization in IndoStar, everybody in the market, all the vendors who came and met us, were doing this project some in some or the other places, which means it's been like, you do it or else you do not survive. So that's what's happening today. But I think that from that piece leads to a very interesting question: is we do everything for the customers. So it's very critical for us to actually make sure that the customer, the customer experience has to be extremely seamless, and he should be looking forward to use the digital app or the system that we have created for the customer. So, Amit, in terms of a customer experience perspective, how do you think that the digitization from an end-to-end journey has progressed in the last, let's say, I think we can say the last 3-4 years, where the whole spurt of lending, digital in the lending space has taken a shape. So, let me kind of, if you can let us know what your views are on that. You're on mute, Amit.
Yeah, sorry about that. So thanks, Jay. I think that's a great question, and thankfully it blends very well with us. We are a new age lender. We've been in business for about 4 years. So so when we were at the drawing board, we started drawing everything from the experience of how all lenders have been growing. So very, very conventional, not breaking the rule book, just making sure we're ticking all the boxes right. And as we started realizing things are changing, rules are changing. And so while we documented everything from a process standpoint, which was very, very physical centric, by the time we kickstarted our operations, we were already phygital. We started doing customer acquisition, partly digital, but partly physical, because we had equal weightage to our channel partners, be it an offline channel partner or be it an online aggregator, and so on and so forth. But gradually we started to realize efficiencies were brought in much more when we had all our integrations in place. And by the time we could get everything together, we realized our process looked very, very different from what we had started drawing out on the board. So my acquisition starts rather than from a partner who's completely offline. Instead, now I go to an aggregator or a marketplace, or let's say even a preference is always with an offline partner who's willing to integrate with our system. So all our documents of a potential customer could come into our systems real time. We used to do a lot of our data plotting manually, because we'd get a lot of photocopies of bank statements, financial statements, etc. And that's how we classically assumed to be operating for a while. But within less than a year, we realized there are so many good softwares available, and we started leveraging, researching, and we realized what could take us 2 to 3 days worth of data plotting exercise now suddenly changed in 2 minutes. And then GST came into play. So while we had the VAT kind of a structure to evaluate, now we started looking at GST. So we started working with our vendors again to see how we can do a triangulation between your GST returns and your bank statement analysis. And then you look at your bureau scores to see, when your customer probably gives you 1 or 2 bank statements and the loan has been taken from a third or the fourth account. So it still kind of stays a suspense to us, which is discovered later in the stage. So with this kind of integrations done between so many systems, one, our risk was mitigated much faster. Second, because of digitization, the time it took for us to make a decision was very, very quick. A ratio started coming up by the click of a button. Analysis were happening at the click of a button. And then we further streamlined the process to have all the data points that we use for scoring coming to us in a very seamless fashion, which our origination and the underwriting systems could consume. And that really made the job very, very simple. So our track, which we assumed to be initially could have been a 4 to 5 day, suddenly went down to 2 to 3 days, and then gradually into 1 and 2 days, really. Now, there are still some elements which we could not completely override then. And for example, we were relying on a scoring based on data that would have got from a customer's mobile phone. Android allowed it, iPhone didn't allow. And then Google rolled out a policy to say, you cannot take that data again. So we had to roll back our model. And then there's a consent process, etc. So we started figuring that maybe relying on surrogate data for your advanced modeling may not be the best approach. So we kind of held that back. So we had to retweak some of our processes. So, so process has been a constant change while we keep all of this in mind. And a lot of the activities that we planned initially were very inward looking. We wanted to do everything the right way. The focus was a lot on us as to how we want to do it. But gradually we realized that our processes will have to be attuned more towards how the customer prefers it. So we had geared up our systems to actually be able to do an Uberization, if I may, of our feet on the street people. So if I know a customer is sitting in one part of the city, another customer is on the second part of the city, somebody is requesting for a document pickup, I will find out from my own tracking mechanism who is my closest representative who can go and pick up the documentation to speed up document delivery. And this was done about in 2018-19 when we started operations. We thought it was a great thing to do. Today we realize that's not needed because that entire process of document pickup and delivery is gone. It's all completely electronic, right? So we have constantly been revising our processes to take into account this kind of paradigm changes. I won't even talk about financial analysis and comparisons with peers to derive our underwriting score, because I think that's mostly what everybody today does. But the interesting thing there is we had the biggest challenge of being a newcomer to the industry. We were not sitting on a wealth of data to have our models done right. Well, we feel that we are nimble-footed because we did not have a bag to carry, but at the same time, not having a lot of data to make a decision put us on the back seat, because that means we could not rely on our AI ML models itself to make a quick decision. So we had to wait for a time until we collated a lot of data. We built artificial models to simulate our requirements and then kind of do a parallel run to benchmark with our own decision making. So that's basically where there was some amount of learning for us to see how we can fine tune the models. So all along, acquisition process, which started mostly physical, moved from physical to digital, and then gradually moved to complete digital. Underwriting process, which was partly physical, partly digital, then moved to mostly digital again. And once the decision making is done, all the documentation that is needed from the customers, that can happen through e-channels. Everybody mostly uses a phone, thankfully, for the segment that we operate in. So we've not been constrained by the usage of not having a smartphone by the end customer. However, we do understand, I think, when we go to the rural markets, which is a segment that we don't operate today, we could be constrained by some of our customers who may not be using a smartphone. So sharing of documents could become at that point a little tricky. Now, having said that, the one important thing that we are now noticing is everybody's moving towards OCEN and the account aggregator model, which means now I don't have to have a customer who is going to be dependent on a smartphone necessarily. At some point, consent could be provided, so we could actually be consuming the data through just a consent, and it will be coming through the service provider themselves. Similarly, if there's a uniform mechanism for us to share data across all our financial institutions, that makes our integrations much more streamlined. So I think as we talk about the process that we do today, we definitely anticipate a lot of that will change over the next 6 to 12 months, as and when OCEN gets more streamlined, as and when more and more players start coming on the account aggregator model on the platform. A lot more integrations happen with service providers, be it bank statement analysis, be it bureau integrations, all of it culminating into taking collaborative data from so many different institutions coming together. We see underwriting, which takes the bulk of our effort today, go down to just a few minutes. And that really means even for the most complex of loans that we typically dole out today, which could take us more than a day or so, can actually go down to minutes. So all in all, customer is going to be at the luxury of having just a few clicks to be doing. And that's really all that they would have to do. And we as an institution will have to continuously change our processes to take into account how disruption is happening, how new ways of lending can be done, how we bring in new product mixes to the market, how we maybe add new products to our portfolio, and to that, how our processes have to be changed. So all in all, I think it's a battle of how a new product is launched, how digital changes the way we do business, and how we attune to the changing environment.
Thanks, Amit. I think when we do processes in the as I always say, in the four walls of an AC room, we really don't know what the customer at the ground level actually wants. So it's very critical for us to integrate what the customer want versus what we build in the in the corporate offices, as they call it as. But I think when we talk about customer and talk about customer experiences, and there's one side which we talk about digital. We always when the word digital comes, people think it's paperless. There should not be a paper across. So turning to Anand, and this is a myth even I have, and I think we can always debate and discuss. How do you see this whole flow of the lending coming into a paperless model, Anand? The whole flow. I mean, do you think it's a reality? Do you think it is there to stay? Do you think we still will have to bring in the hybrid model of the digital and the physical? So I mean, good to hear your views on that, Anand.
Sure. Thanks, Jaya. So I think the irony of the question in some ways is, we're dealing with a purely digital commodity, right? So the loan, the underlying, the money, that itself is digital, but then we're applying a number of processes to it, controls to it, and that's where a lot of the paper comes in, right? So our perspective, and being paperless is a necessary condition before you can be fully automated, right? Because by definition, if you're dealing with paper, then the process is not automated. To the extent that you've got paper, then you've got manual processes over there, right? So when we went out and we set ourselves to design and build our product in it, the first thing we did was we said, okay, let's sit down, let's figure out what do we do to get it entirely paperless, right? So what are those input points? What are those points at which paper actually comes in? And the approach we took was, like when you design a system, a good way to start is to say all manual input is error, right? So we sort of said, okay, let's say if we say all paper involved is error, how do you go out and reduce all of that, right? And then you can quickly see that one set of where you're generating paperwork is due to internal processes, and the other is due to the external environment and what's available, right? So some of that you can obviously therefore control by yourself as an institution, and some you cannot. You can influence, but you can't control. So when you then break it down, you see things like borrower information, security information, then there's decisioning and fulfillment processes within, and then ongoing customer communications, right? So these are largely the four sort of sets of activities where any kind of paperwork gets generated and where the automated process breaks down, right? I think in the near term, we're getting to the point where there is no reason where borrower information needs to be paper-based, right? Already there are ways of verifying borrower information, receiving borrower information entirely digitally. Rahul was talking earlier about blockchain and blockchain-based processes. So once you start having greater usage of blockchain, what that means is you have trusted sources of data, decentralized sources of data, trusted that you can tap into for various verification purposes as well, right? Same thing with security information. And if you're reliant always on one central institution to verify various things, then the speed you can go paperless is the speed at which that institution actually adopts digital technologies. Whereas if you move towards more decentralized system, which is a trend of where things are going, or if you are able to generate trust through those institutions, then you have another level of going paperless over there. Right? So an example, what we've done here with a customer in Australia as an example is, typically financial information for any commercial borrowing was always done, with audited statements. You have to get financial papers signed by the auditor, certified, stamped, etc. Right? But we're moving more and more towards a world where, especially in the SME segment, a lot of the financials are done through the online accounting services providers like Xero or Mayo, QuickBooks, things like that. So what we've done is we've said there are ways using AI-based models to actually verify whether someone's cooking the books or they're actually giving genuine things, right? So you don't have to necessarily wait for paper-based statements and a signature by an auditor, which in itself could be forged. So I think the short answer to your question is the trend towards paperless real? Yes, it is. Are we going to get to paperless? I think for a number of segments, you could go paperless even today. For the segments that you can't go paperless, I think the time horizon is getting shorter and shorter when you can get to an actual paperless process, right? And when you talk about customer experience as well, I think the reality is the more paperless you go, in many ways the customer experience improves as well, because no one wants to go out, dig for the original paperwork, get them attested, get them verified. It's all a real pain, right? So I think it removes a lot of friction in the process. It brings automation, reduces the cost, etc. So we see paperless as a reality. We're designing our processes based on paperless. We're designing processes for 100% automation with no manual input, and we're seeing more and more adoption of that, and we think that's going to be the reality very soon.
I think, Anand, it just validates my concern that where I have, the business teams coming and telling us that, no, we can't, we will not be able to go paperless, we need paper. But I think more and more these conversations happen, it more and more validates, saying that we will reach a stage that paper will be off and everything will be through the digital flow itself. So I think while we are very focused and we kind of are very we're sure that we want to go digital, I think one of the critical points in this entire flow will be the decisioning process. So where in lending, decisioning to whether I want to give a loan to a customer or not is a critical point. And that brings us to the question which I will share with Rishikant, and then I would also love to hear Gaurav's view on that. Is how do you see the analytics scorecards and the decision making, the credit decision making happening through the digital implementation point? So, Rishikant, can we have your views on that?
Yeah. Thank you for that. If we talk about digital, and when we are talking about digital in NBFC, our lending platform, so the first and foremost thing which comes in your mind is how to take the decision on that, whether I have to lend or not. So if we see these two parts, one is analytics, other one is the scorecard. So we can break it into two parts, because analytics is the way we are really looking for the customer, or really we are looking for the product which is going to be offered in the market. So if we see, let us go to the roots of how the analytics have come into the picture and how the things have come into the NBFC world also. If you see, analytics has been done mostly by social media platforms as well as the e-commerce, where they are really deciding about who is really preferred customer and what product can be offered to them. Why can't this analytics can be used in the NBFC world also? So with that idea itself, we are analyzing, and most of the NBFCs, even microfinance, are analyzing all the structured as well as unstructured data which is available in the system, which is available in the papers. And this analytics is going to be very useful in the sense that we are now come to know that what is the requirement of the customer beforehand itself. That is the most important thing. If you see, analytics in the NBFC world is used now for the sourcing, for the monitoring, for credit decisioning, as well as collection. So it's not a small thing which we are really only analyzing, keeping the and plethora of the data is there to take decision, but it is really utilized for all other decision making in the form of sourcing, monitoring, credit decision, as well as collection. Now comes to the scorecard. Yes, scorecard is the most important line, because when we are really onboarding a customer, we need to know about the credit history or credit worthiness of the customer. So earlier, before digitalization, what was that? Our credit officer visits, go, see, feel, and analyze the data. But now with the scorecard, one point is there where we are having qualitative as well as quantitative formats of the data, which can be used to take the decision easily. And really, it's not only to take the decision at one time, but yes, if we are using a scorecard, and NBFCs are using scorecards, and these scorecards are further analyzed to take in future decisions also, because these are validated, certain parameters are changed, certain parameters are added. So the scorecards are going to be the next step in the NBFC lending. And moreover, paper-based scorecard or scorecard which were really not in a seamless form, it was used earlier also. But what is the change with the digitalization is that whatever the data requirement for these scorecards are seamlessly coming from the system itself, from the different sources of the data are there. So really, if we are talking about digitalization, if we are NBFCs are known to touch the last miles of the customers, because these customers are not the formal customers, where we can use really the analytics as well as scorecard is the best method it is going to be. But one risk, what is, since I'm a risk person, I'm seeing the other angle also. What is the risk we are running in that if we are using totally based on the analytics as well as the scorecards? Yes, we are running a risk that we may onboard a customer which may be false negative or false positive in the way. But the thing is, we here comes is the validation of the models, validation of the scorecard, as well as validation of the our analytics results. So these results needs to be validated before use in the system itself. It is not like that in the digital world everything is right to take the decision. No, we need to take certain pause, try to analyze, try to backtest, try to validate the data and take the decision on the basis of that. But yes, the way the fintechs are coming, the way the companies are changing themselves, integrating with the fintechs, yes, decision making is going to be very easy, in the sense we are having all data one in hand and we can take informed decision, at least we can say that. So digitalization is going to change in a two-way. One is that lot of information to take the decision. Second is that take the correct decision. So even and it will be mostly and most useful for the NBFCs, because most of the unstructured data is with the NBFCs only. So that sense, I see it's a great scope for the analytics as well as a scorecard in coming future. And that is the going to be the second inning for the NBFCs, where we are analyzing the data in a different way and taking decisions on the basis of data only. That is the move way forward, and that is the tomorrow for the NBFCs. And everybody has to integrate, whether you are developing yourself or you are integrating with the fintech. There is no limit, but we have to move around. And the analytics is the one part where we can say that, because you see the decision is not only made on the basis of what the customer's requirement. Decision is made on the basis of what the customer is using, what the customer is using on the whether what song he's listening, where he's visiting and all. So these all data will be used for the scorecard as well as analytics platform. So in nutshell, we can say that yes, analytics is going to be used, whether it is microfinance, even a smaller organization like microfinance, where we are really dealing with the customers which are really acquainted with the technology and all. There also, this is a very useful platform, and really, and I see most of the microfinance also gone for the digitization, and this is right from the sourcing to the payment. So that is the tomorrow for the NBFC. Thank you, Jay.
Thanks, Rishikant. Gaurav, your views on the scorecard and the analytics piece, if you can share your views.
Sure. Thank you very much, Jaya, and thank you.
I also we need to be a little careful about the time, so please.
So I'll be very brief. Thank you so much, Jaya, and thank you all the panelists for allowing me to spend 5 minutes of fame probably talking about the credit analytics. So traditionally, we are into micro and medium SMEs, and so far we have been following the old method of balance sheet approach while doing the customer analysis. So looking at the historical data of the customer and coming at a meaningful decision. Yes, when GST came in, that was a game changer for us, because now we were able to have the cash flows assess easily, and with the bank statement analysis, it was becoming even more easy to assess a customer in terms of the flows of the data that is available. One interesting thing that we are doing is looking at the surrogate data. One of the critical factors which has helped us a lot is the social economic scoring of a customer. Looking at the city where the customer is coming from, and looking at the past 10 years horizon of the city from the economic growth in the city, that is becoming a major input parameter for us while taking a decision for our MSME customers, and that would continue to play a pivotal role for us. One interesting thing that we are doing now is we are looking at machine learning comprehensively. The idea is that with machine learning, the number of data sources that you can factor into credit model are becoming theoretically infinite. So there are countless variables that might help you predict the applicant's ability to pay back the loan. And machine learning is really good in finding data patterns in the large sets of data that is available. One thing which machine learning could also do is that it can factor in the data points that are unknown to predict a borrower's likelihood of paying back a loan. And with us in our organization, what we have done is we have built a data science model with a tech stack, which is consisting of a comprehensive data lake, and along with the AI ML model, we are able to drive the data in a structured format to the machine learning algorithms without any challenges. And the modeling platform is able to communicate with the data lake with all the data sets comprehensively. So, in the nutshell, what I'm trying to say is that innovation will be the key here. You will have to look into things like AI and ML and form a quick decision-making factor from the credit decisioning standpoint. If you don't do it, you will fall flat, and that's what we will try to work on as an NBFCs and as a digital organization.
Thanks, Gaurav. I think when it comes to these decision making, and I have been witnessing it. The need for a strong system, while digital platform itself needs a strong technology platform, the need for a very strong based engine to run these credit scores are very critical, and that obviously leads to the next question of which I would ask Mr. Kishan Kumar to share us some views on the infra requirements for a digital platform. How do you think an organization should equip themselves in the infra space when it comes to a transition of into a digital lending platform? Mr. Kishan Kumar, can you just share your views on that, please?
I think the most important thing that one looks at a digital platform with all these kind of things which are there is to have a 24/7 system, real secure system, and to ensure that it is available at all times and performs at an optimum speed and capacity. So whether it's a credit decisioning process or Anand talking about onboarding digitally, and today I think most of the things are done online real time. In fact, many of our businesses today, except if it is a compliance related issue or a regulatory issue, there is no documentation. There's all documents are all digitized. So we don't have any manual documentation or forms which were getting printed, almost about 200 pages, 300 pages of forms with terms and conditions. Today is completely digitized. So no more of those things exist. So if you have to get into these kind of areas where you are talking to a customer, where the availability is there, the ease of use is there, the CX is there, that means the customer experience of about doing things. You need an infrastructure which will scale, which is robust, which is managed 24/7, which is secure, and something which you don't have to bother. As and when the customer load increases, the system automatically builds in capacity to these things. And these are possible if you have an infrastructure which runs out of a cloud kind of a mechanism, or if you have some. I don't think on an on-prem you have those kind of features unless you are so well equipped. So in my view, we have moved on to a digital platform. So completely, which is on the cloud. We don't have anything as a data center or today. And we moved this way back in 2019, even before the pandemic started, 2018, 19, we'd already planned for this. And because we are in a very unique type of business, unlike most of the things today that we spoke are more into retail kind of an environment or an MSME kind of an environment, whereas we are into builder finance, and we are into loans against securities for our high net worth individuals and this thing. So everything that we spoke about, right from the online capturing of information, that means trying up with third-party sources. So today, one of the good things that has happened in the industry, in the Indian industry, at least I could say, that there is a lot of data proliferation. That means availability of data through third-party sources, whether it is the government sources, whether it is the SEBI sources, whether it is RBI or Ministry of Corporate Affairs. All these kind of data are automatically linked into the system. So when you build these interfaces with all these agencies, whether it is a public agency or a private agency like Standards or Poor or a CIBIL or these kind of things for your credit scoring, the areas, you need to have a very secure and infrastructure which will allow you to do all these kind of things. It is not just the piece of software, but also the infrastructure which allows you to get into these kind of things in a secure manner. So that's something which is very important for us. And we have been doing this on a cloud-based platform for almost about 2 years now, more than 2 years plus. And then I think that the way it needs to be structured is also how do you get this entire thing in terms of data. So previously you had, now you have PDFs all over the place, or you have documentation all over the place, and you need to have a secure place where you can store that, access that. That information needs to be available to the customer at any point in time, or to the relationship manager, the distributor, the partner, the entire ecosystem, if I may. So that's a very important aspect. The second important thing, what Rishikant and Gaurav stated about getting into analytics and to data, you need engines which are super speed, which are very fast, which have the kind of memory capability and in-memory processing capability which requires you to take decisioning very quickly. So those kind of engines are something which one needs to plan for, one needs to look out, and how do you scale those things as the volumes grow? Or is it only because the volumes grow, or is it because of the way you have structured your entire digital processes? Those are also very important. So one of the most important things I think is to break the silos within the organization, create your processes, put up an infrastructure which is actually this. So I don't think it is a problem of lending per se. The traditional work players will still be suffering, and I don't think have got any future in my view, because the way the lending market has changed with all the kind of fintechs and people getting into the market, the scope has drastically changed. The product mix has drastically changed. The microfinance mix has changed completely. You have subsections in microfinance. Similarly, for us in the real estate sector, whether we do building finance, whether we do land finance. So all these kind of things, when you bring together, I think something which is scalable, flexible, not needing any maintenance, and auto enhancing capabilities are something which I really look at, which should be the kind of infrastructure that you look at. And your ability to integrate with third-party sources and other things is something, again, which has to be in a seamless manner so that you get data. So gone are the days where you use manual paperwork and other things. Partners are forced to use digital. So whether you use it on your mobile or whether you use your on a portal, all those things are a part of the present, and I think is the beginning of the future. So that's the way I see this entire market going through. And the next few years, unless companies and organizations change their approach, I don't think they have any scope or potential for anything. So infrastructure by definition is cloud, or any other way, whether you do it on-prem, off-prem, but something which can be scaled and you don't have to ask a guy to go and get a hard disk or memory or put those things, which I think is the ways of the past. And I think the present important thing is how quickly can your engine and rules engine scale up to meet the changing business and the dynamic business needs. So dynamic changing. So the classic example which I could always look at was companies like Goldman Sachs, who launched the entire asset platform within less than 3 months or 6 months to a tune of almost about 20 billion. So that's the kind of a speed, and that's the kind of market that you are talking of. So just look at the potential that we have in our country and the way I think the markets are dynamically changing. So today's the lending cards of the world and the policy bazaars of the world which are making the difference, and they don't have any limitation, whether in terms of technology, whether in terms of people, whether in terms of reach. So I think that's the way forward. And data and analytics, of course, that's the next dimension. So no more offline data, it's more of real-time data that you are talking of. Thank you.
Thanks, Mr. Kishan. I think very aptly put. Cloud is the way forward, and I think with all of the discussions that we have been having, I'm sure all of us are moving to digital. For one, it's not just because we want to be digital. There are a lot of outcomes that come out of digital, and the question to Anish to share his views will be all these actually derive things like cost benefit. There are risks adopted to while doing digital, the challenges. But I'll also state, Anish, the last member being on the panel, there is a short of time there. So quickly, can we have your points on these, Anish?
Sure, Jaya, and thank you all the panelists. I think the fundamental thing is yes, digital is going to be there in the future, but I don't think digital is a one size fits all strategy. I think we are still at a euphoria phase. Customer segments will evolve, and we'll find out that each NBFC, each institution will have to figure out what's right for them. For example, are you tech first or are you tech enabled? And within that, which part of value chains you want to disrupt? Is it acquisition? Is it collections? Is it underwriting? Is it everything? For example, India has got 6.3 crore MSMEs. Only 1.2 crore are registered on GST. Rest don't even have data. Lending, alternate database lending, everybody talked about. But we have all seen that so far the success has been proven only for very short term, small ticket loans. So there's a lot of work to be done. I think fundamentally, I think the challenge that I see having transformed it within my own company is as follows. A, figure out who is driving the digitalization process. It's no longer technology's perverse. It has to be business and technology together. Second, the reason we are driving change is because we want to cut down cost, increase revenue, and of course, there's obsolescence that's happening. We don't want to land up in a situation where the total incremental cost of technology is higher in the long run. And that can happen with a lot of failures and wrong investments. Therefore, you have to be asset light in your technology escape. And that's where concepts like low code development or even no code development is a very good approach. Things like MVP based design, where you have agile methodologies coming together, a platform based approach rather than software as a silo approach. But mind you, if you're talking about a traditional NBFC, all these things are fantastic for a company which is starting today. But if you have been doing your business in a particular way for last 10, 20, 30 years, it's very difficult to transform. And I think it starts with your culture, it starts with your processes, and how do you show early wins? The people, the sales people, the credit people, the operations people will be skeptical. And therefore, it's very important to show early wins and demonstrate the MVPs. I can tell you that if anybody is saying that I'm going full digital and it's been a great journey, I think we are headed for a crash. Unless you are having 8 failures out of 10 failures and you're able to learn and recover fast from that, I don't think you are doing a digital transformation right. That's been my experience. And therefore, I think in a nutshell, the future is digital, but what is digital for different people will vary. And therefore, pick and choose your bets well is very important. Otherwise, with all the transitions that are happening on the regulations as well, GDPR will come in on one hand, data proliferation on the other, and data privacy. So you have to be nimble, and therefore technology cannot just be an investment. It has to be a continuous recalibration, and your system should allow you to do it fast and move fast. So that's in a nutshell my view about it.
I think this is a very interesting discussion. I think it can go on and on and on because there's a lot to discuss, lot to learn, lot to share, and lot to understand, and probably collaborate as organizations in terms of what works best for the other and what does not work, what has not worked. What is good for one may not be good for the other. So it's always to, instead of being the starters, there's no harm in being being copying someone, because it's better that you don't do the error of what others have done. That's a way to move forward. But having said that, I would have loved this discussion to go on, but having a limitation of time, we come to the end of the session, and it's been a very interesting session. And I think while I work for the organization, we're doing a lot of work on the digital space. I think all of what you said actually has only added value. Thank you so much to each panel member, and thank you, Sana, for helping me host this particular discussion. Thank you, everyone.
Indeed, that was a great panel discussion session. Thank you, Ms. Jaya, for moderating the panel, and thank you so much, panel members. Fantastic having all of you here on the busy working Thursday and for giving time on such an important subject and topic. As also thank you to our viewers, the attendees who are watching us live, and I'm sure a lot of takeaways from all these interesting people from such an expert panel like this. Thank you so much once again, and thank you, Ms. Jaya, for doing the honor of moderating. Hope to see all of you in the next edition. Thank you.